Ever been confused by exactly how whole life works? Not to mention all the different riders needed to transform an ordinary old whole life policy to act as your own private bank or retirement vehicle? Well, my apologies in advance to any car enthusiasts out there, as I use this race car analogy to explain the interplay between the different components of a whole life policy, along with the various riders bolted on when optimizing for cash value performance. For those of you who don't know me yet, I'm John Hutchinson, affectionately known as Hutch, and my site bankingtruths.com has loads of articles and videos on how to re-engineer and optimize life insurance policies for wealth building. Most people researching whole life soon learn that in addition to the growth that's guaranteed inside your base whole life policy, there are also dividends, a paid-up additions rider, a term insurance rider, and of course, none of this works without your premium dollars or a mutual life insurance company to put these premiums to work. So let's drill deeper into these different parts of the vehicle. It all starts with this dark gray heavy engine block, your base whole life policy. This is the core nucleus of performance, which all the other components revolve around. Some of the other aspects of a whole life policy or riders may seem more appealing to you, but none can exist without the integral structure of your base policy. This other shiny silver souped up engine over here is your paid up additions rider. Sure, your whole life vehicle can move without this bolted on addition, but it won't be moving very fast. On the other hand, if you design your car with only a standalone paid-up additions rider or stack too much of this rider onto your car, you will essentially be disqualified from certain races, mainly the races dealing with favorable taxation. Now, there is a workaround if you want to add a disproportionate amount of paid-up additions rider bolted onto a small base policy. Going back to our car analogy, you'll need more overall support from the chassis in the form of a death benefit to support the added performance components. Now, this can be accomplished two ways: by adding more bulky base policy with its heavy metal support, or you can add in a streamlined titanium chassis in the form of a term rider to accommodate a lopsided amount of paid-up additions. Since a term rider provides this extra death benefit for a fraction of the cost in adding more base policy would, we've represented it here as the lighter, shinier silver titanium chassis versus the dark gray heavy metal that comes stock with the base policy. To be clear, the term rider or streamlined chassis itself is not a performance factor, other than the fact that it provides the necessary support for more high-performing PUAs without the extra drag from adding more heavy base policy. Let's talk about dividends. Since they are not guaranteed and both a base whole life policy and a PUA rider can function without dividends, it's best to describe them as a special additive. This is especially true since the exact amount of dividends you'll receive will fluctuate regularly throughout the life of your policy. It's no accident that there are three different colored beakers represented here, because a dividend is made up of three distinct components. The interest component based on what your mutual insurance company earned on its entire portfolio of investments that year, the company's actual mortality experience that year versus what was originally projected when underwriting that particular block of business, and last, how well the mutual company is managing its operational expenses. It's also worth noting that these additives get measured and dispensed by your pit crew or the mutual insurance company you choose. Since your policy will come into a pit stop for this extra juice every single year, both the quantity and the quality of these additives will vary depending on how good your pit crew is. You want a crew with both a solid historical track record as well as stellar recent results, since their additives will enhance the performance of both the base policy and the PUA rider. The bigger the engine you've built, the more dividend additives your car will be entitled to, assuming that you've also been putting the necessary fuel or premiums in along the way. I'm showing two cans of fuel because some of it goes to the base policy, which will be burned much less efficiently in the short run, but still yield respectable long-term results on its own. And some of your premium fuel will be devoted entirely to the PUA rider, where it boosts both immediate acceleration and long-term performance. Hopefully whatever liberties I took with the racing industry didn't annoy too many people, and more importantly, that they helped you better understand what's under the hood of a properly structured whole life insurance policy designed for banking and retirement.